All right, welcome to Financial Independence Retire Early. This is the 23rd episode. My name is Bird. I'd like to thank you for watching. So on this 23rd episode, I'm going to be talking about venture capitalism or venture firms. Basically, just like an introduction on how I understand venture firms to work. Basically, I believe that venture capitalism is really, really important for me as an entrepreneur to understand how venture capitalism works because venture firms are a large source of capital and access to funding. Venture capitalists are a large source of funding and access to capital. So it's really, really important for me to understand how these things work because I am looking for funding, right? I am seeking access to capital, but also as a I'm an investor in training myself. I also feel like it's really, really important for me because in the near distant future, I hope to become a angel investor and evolve into building a venture firm of my own. Because there are some countries on this continent of Africa where venture firms don't exist at all, and even in this country of South Africa, one of the most developed economies on the continent, we still have an underdeveloped, really underdeveloped venture firm. Because myself right now, I would not even know where to begin, where to go if I would be looking for assistance from a venture firm locally. But I do know that internationally, there are really large venture capital firms that are investing in other companies on this continent. So again, it's really just for that opportunity, right? Even if it's a hypothetical opportunity, for that hypothetical opportunity, I need to understand how these things work, lest I come into contact with a venture firm and I'm looking to take cash from them. So yeah, episode 23, you're talking about venture capitalism and venture firms. I think like the oldest example of venture firms is like the Medici family, right? If anybody knows the Medici family invested a lot in Leonardo da Vinci. They gave him the money and I believe also the time and the space for him to like think and invent and create and draw and paint a lot and all of the wonderful things that he did. He probably wouldn't have been able to do them if he did not have the finances, which afforded him the time and the space that he received from the Medici family. So that's why I would say that a venture firm or a venture capitalist firm, a venture capitalist company, is basically like an amalgamation between family offices, angel investing, and investment banking, right? So you take family offices, angel investors, and investment banking, and you kind of mush the three together. You're probably most likely going to come up with a venture firm or a venture capitalist firm. So, look, I'm going to do a description episode after this. So in case there are words that I use a lot in this episode and you don't know what they mean, I'll give us a definitions episode after this because I was about to explain what a family office is and no, I'll give us another episode for this, right? So how a venture firm works is if Bird is going to start Bird Ventures, which is the hypothetical name of my venture capitalist. I don't think I'm going to stick to it. Bird Ventures is boring. But for this, for this story, I'm going to start my own venture firm called Bird Ventures. And I'm looking to raise a fund. That's how they go about it, right? So I say, hey guys, I'm starting my own. I have my own venture firm, which is called Bird Ventures. And in Bird Ventures, we're trying to raise a 200 million rand fund, right? And I'm going to put up 20 million of my own, right? So I'm going to stake, or I'm going to stake about 20 million of the 200 million, right? Or I'm going to carry 20 million of the 200 million. So then I'm going to go to other large sources of capital. What are these large sources of capital? These are, again, family offices. These are other angel investors. These are university endowments, right? So you imagine a university with like R1 billion endowment. The university probably can't invest the money itself, but it will give the money to venture firms to invest for them. And then with the returns and when the money comes back, then the university can use those profits to invest in its own like science, research and development or whatever, whatever the people that donated the money to the university want them to do with the money, right? So these are also trust funds, philanthropic family foundations. So you can imagine if a family foundation is structured as an NPO, but you still want to make a profit in order to kind of fulfill the things that you're trying to fulfill. Because you're structured as an NPO, you're going to give your money to a venture firm to invest for you. And then that venture firm will return the money to the NPO, and then the NPO will continue running like it's supposed to. So NPOs, NGOs, other kinds of institutions, philanthropic family foundations, family offices, angel investors, university endowments, trust funds, all of these large sources of capital. All of these large sources of capital will then invest into a venture firm. And that is why venture capitalism such a large capacity for funding and access to capital because they get their money from the largest pools of capital in the world, right? So venture firm is really, really important place for us to get capital, especially as a startup, because they have a lot of money, because they get their money from the richest, most wealthiest groups of people in the world, right? So again, Bird Ventures is raising a 200 million rand fund. We're putting up 20 million of our own. We go to these universities, these family offices, these NPOs, these NGOs, these foundations, and then they give us the rest of the 200 million. And then we say, okay, we got 200 million. We're going to invest in other startups or in companies. We're going to invest a minimum of 2 million to 20 million at a minimum buy-in of 1% to 15%, right? So if that makes sense. So I'll say I have 200 million rands. I'm willing to invest in any company that I like. I'm going to invest a minimum of 2 million rands, a maximum of 20 million rands. And when I buy in, I expect to get 1% or maximum 15%. So these are usually descriptions that are found in the ventures term sheets for their fund, right? And then they go around looking for these companies. Now, typically the companies that they look for, these are companies that have a focus on high growth or high growth startups with products or services that have a potential to reshape or to disrupt markets, right? Or even create new markets, right? But basically, these are fast growing companies that have a high capacity for scalability. They may need large capital injections in the beginning, in the middle, and in the long term because of the research and development of their product or their services before they even realize a profit, right? So you can imagine a Facebook, an Uber, right? Apple, Amazon, all of these companies, it took them tens of years, 20 years, maybe even until they realized the profit, is because they kept on getting all of these funds from venture capitalists. So the venture industry is what allows startups to be able to grow for about 10, 15 years, even before they make a profit, because these are people that understand and have the patience, long-term thinking to invest in risky companies. For example, Amazon as an idea might not have been able to get money from a bank, but could have been able to get money from a venture firm because venture capitalists understand, right, that, high risk, high reward. And typically these venture firms would invest in like 2 or 3 companies with the same kind of business model. Because as they say, 3 out of 4 businesses fail within their first 5 years. So it only makes good business sense to invest in multiple companies with similar business model. And then over time, the best one will survive. And that's where you're going to make all your profit back. You would have lost 1 million rands here, 1 million rands there, but you make back 5 million. And then overall, you've made back like 2 million, right? So yeah, these are basically they provide access to capital where traditional channels may feel like there's a high risk reward. And that is why, yes, venture firm mostly works in technology, or venture firms are most pronounced in technology. That's why in the modern day, right, I've mentioned the Medici, but in the modern day, the largest venture firms, the most popular venture firms, the most successful venture firms are Sequoia Capital and Klein Perkins. And these two are kind of were established and live in Silicon Valley, right, where a lot of these startups happen. So and a lot of these technology startups happen. So venture capitalism has a really, really strong relationship with technology and with funding research and development in technology, because they kind of understand that a lot of good technology companies need large capital injections way before they make a profit, right? So that is the ecosystem of venture capitalism, and that is the basics of how it works. So as an entrepreneur, if you're going to be looking for money at a venture firm, at a venture capitalist company, you need to understand how they go through their capital raises. But even before that, I'm going to take us through their investing rounds, right? So if you're going to be invested in by a venture capitalist company, you need to understand how they go about doing their investment rounds, right? So for example, you have an idea, right? This is Bird. He just has an idea, and I'm looking for funding so I can kind of register my company, buy like computers and pay for internet and just the basics to have my company running. I'll most typically go to friends and family who have money, but if I'm lucky, I'll run into like a rich uncle or a rich friend of a friend who will then become my angel investor. So initially the first investors in your seed round can be called angel investors, and these are the people that give your company value or that give value to idea. So I just have an idea and I'm looking for funding, and this guy's willing to give me 10,000 rands for 10% of my company, right? Effectively making my company to be worth 100,000, but also giving me the 10,000 rand startup capital that I need to effectively establish my company. That is usually your seed fund or your seed round, where you have your angel investors or your first investors invest in what essentially could be just an idea, right? And then once you have that money and you've kind of registered and established the company, you're going to go into your next capital raise round, which is called Series A. So from seed, you go to Series A. Now, in your Series A round, you're probably now kind of established. You have a product, or you're looking for product market fit, or you're looking for market fit. You have a product, but you're still refining it, basically, right? And you may even have like a niche customer base, right? So now your idea, you're trying to now create a product, or you have the what is could be called the beta phase, where you have an example or a prototype of the product, and now you take your prototype of your product and then you go into your Series A round, and then that's where you get funding in order maybe to finalize your product, because what you have is a prototype. Then you go to Series A, you get more money, and then you finalize your product. After that, when you have your product and you've maybe even begun selling your product in mass, you're going to go to Series B. So from seed, Series A, Series B. Now in Series B, your company has a considerable revenue, because you're selling your product, you're making some money, you're established in some markets, and you're just looking to expand, right? And that's where your Series B funding will come. And then after that, you're going to go into Series C. Get it now? So seed, A, B, C. Once you're in Series C, your company has grown up a bit. You have some systems in place. You have a defined executive. You have defined markets, and you're now just looking to go global, right? And then you get your Series C funding, because now again, in seed funding, it was just an idea. In Series A, it's a prototype. In Series B, you're selling and you just need growth. And in Series C, you're established. You have markets. You have an executive, and what you're looking to do is basically just like go global, or maybe even merge with other companies, or even acquire other companies. So you're going to go into a Series C funding. You can do D&E depending on the evolution of the company, but effectively you're gonna go do an IPO, or initial public offering, and that is where a lot of people then get their exits, right? People that invested you in the beginning, A, B, they're now looking to get to cash out and make their money back, and a lot of them make their money back in an IPO. That's when people exit. You could also be allowed to exit as a founder or as a CEO, but typically a lot of founders and CEOs have like lock-ins where they have to vest. For example, if somebody's going to give you like, maybe you're in Series B now. I see your product and I love your product, and I promise you that I'm going to give you 100 million rands, right? And I can set targets. I can say for every 10,000 units of your product you sell, I'll give you another 100,000 rands, right? So this is how they kind of lock in. This is where the investors, the venture capitalists, and the entrepreneurs, the founders, and the inventors, and everybody else can kind of, it's described in their term sheets, but this is how they find a balance between me giving you money and me giving you a return and actually building a business. So there may be lock-in periods, there may be vesting periods in order for the venture firm to make their money back. But these are also kind of incentives for you to actually build the company and sell the product or sell the service. So these are things that you need to understand when you're going to create a relationship with a venture firm, right? Is on the term sheet. But the other important thing to understand when you're doing term sheets is your pre-money valuation and your post-money valuation. So if you go back to the example that I gave, a distant uncle of mine, for example, would give me 10,000 Rand for 10% of my company. Since it's an idea, there's no real valuation, right? But the moment he gives me that 10,000 Rand and I give him that 10%, my company is now effectively worth 100,000 Rands. So if 10% is worth 10,000, then 100% is effectively worth 100,000. So he has effectively valued my company at 100,000 Rands, right? And it's still an idea. Now I'm going to Series A. I received the 10,000 Rand from my uncle. My company is worth 100,000 Rands. Now I go to Series A. Now I say, well, I want to sell another 10%, right? But this time, I am selling this 10%, not for 10,000, but for 30,000, right? So initially my 10% was worth 10,000, but now 10% is worth 30,000. What does that do? You have a pre-money valuation of 100,000 Rands and a post-money valuation of 300,000 Rands, because this guy in the Series A, in the next level of funding, he is willing to pay 30,000 Rands for 10%. So he has effectively made your company worth 300,000 Rands. And now you're going to go to Series B. Right, your product is finalized, you've done your beta, you've done your prototypes, you've begun selling, but now you kind of have more orders than you can fulfill, so you're looking to kind of grow your company, or maybe you have many more people clicking on your site than you can handle, so you need to buy like servers and stuff. Then you're going to go to a Series B, you're looking for more money, and this time you're saying, well, I can sell another 10%, but this time I'm selling my 10% for 60,000 Rands. 60,000 Rands. What does that do? You came in with a pre-money valuation of 300,000 rands, but now because somebody is willing to pay 60,000 rands for 10%, that effectively puts your company at 600,000 rands. And at every level of these capital raise rounds, that is how they're going to value your company. So you also need to understand what is a pre-money valuation of your company and what is the post-money valuation of your company at every capital raise round and at every dilution, because that's what happens, right? You dilute your shares, or you sell your shares, or you create new shares out of thin air in order to be able to sell them to the new person that's trying to invest in your company. So at every round, A, B, C, D, even in your IPO, right? You're going to dilute some shares, and you're also going to get a pre and a post money valuation. Excuse me. So these are some of the important things to understand about, building a relationship with a venture firm, right? So you need to understand capital raise rounds, term sheets, dilutions, stock splits, exits, IPOs, vesting. Like I said, I'll do a definition episode, and then we can kind of break down what all these terms mean and how they effectively help you to work with your venture firm. But what I need to say though about venture firms, good firms aren't just the firms that are just going to give you money, right? You have a good idea and you need money, and I can give you money. Sometimes money is not enough, right? Money, we know that money isn't everything. A good venture firm, in my opinion, is one that will not just give you money, but they also understand high growth companies or hyper growth companies. And what does understanding how hyper growth companies mean? And it means you need to be able to help these companies draw up their burn charts, right? So if I'm going to give you money and I'm giving you 100,000 rands, I'm going to need to help you, especially if I have given you incentive targets in order for me to give you certain amounts of money because you invested the money. I also need to help you reach those targets, right? So it's not enough for me to give you money and say, well, go ahead and reach your target. I should give you the money and also kind of help you find the talent, find the skill. I need to help you hire people. I need to help you kind of, okay, let me put it like this, dog. If you're going to build a company, and it's just you and your friend, and it's just the two of you, okay, the buck stops with the two of you, right? Everything that needs to happen in the company happens between the two of you. If you're going to grow your company to 5 more people, right, then now you're probably friends and family, people that you know, people that you need to help out. But at that level, you need to start paying out something that's like a salary, right? Because if it's the two of you and it's your company, you're willing to sacrifice not having a salary because you want to put all the money back into the business. But if you're going to take in 3 more people, 4 more people, now you have to give them money because they're helping you out and things like that, right? So even the dynamics of the business change because now there are 5 people involved instead of 2. Now, if you're going to go from 5 to 20 people, now you're hiring people that you don't even know. These aren't even your friends and your family. So even the hierarchy in the company needs to be set, right? We need to know who does what, who says what, who can say what and who can't say what, who can do what and who can't do what, So you need a company, a venture firm that's going to help you understand your growth from 3 people to 5 people to 10 people to 100 people to 1,000 people, because now when you have 1,000 people, it's different. It's a whole different machine. It's a whole different monster. So the best venture firm will not only give you the money to grow from 100 people to 1,000 people, but they will help you actually hire people, right? They have network and talents even within their own ecosystem that can help you kind of fill in the gaps that you need to fill. So in my opinion, the best venture firm is one that understands, right, the role of an investor, but that also understands the role of an entrepreneur, that can sympathize and empathize and listen to and understand all of these ideas and all of these insecurities, all of these frustrations, all of these struggles, all of these challenges that entrepreneurs have. And they also need to come up with the right solutions. And that's where, being able to kind of hire certain people, being able to kind of, help you find the right talent that you need to grow your company. That is why, in my opinion, that is also important. So a good venture firm is not one that just gives you money, but it's one that will give you network, that will give you human resources, that will give you clients, you know what I'm saying? That can help you find the right clients for your business. It's really, really important for a venture firm to help you find the right clients, because again, they can't just give you money and then come back 2 years later and say, pay us back. You know what I'm saying? They also need to help you build your business and grow your company and find the right talent and find the right markets. And, all of these things, I believe, make a great venture firm. So again, the right venture firm understands talent, understands recruitment, understands hiring, understands building networks, understands talking to entrepreneurs, understands listening to entrepreneurs, and also understands that there's certain things that they need to teach you as an entrepreneur. I mean, you might come in as an idea person, you might not necessarily understand how the money works, right? So they need to kind of help you find the right tax people, the right HR people, So yeah, that is what I believe makes a good venture firm, right? Just the human element outside of the money. That's what makes a good venture firm. So yeah, these are the basics of understanding a venture firm. So you're gonna come through with your vision. You're gonna come through with your idea. You're gonna come through with your project or with your future product or service, and then you're gonna go to a venture firm, right? And you're gonna speak to these people, and then they will invest in you because a lot of them do see potential in return on investment where a lot of other companies may not, right? Where a lot of banks may not, where a lot of investment banks may not. So VC firms are kind of the best ecosystem for startup companies because it is within their definition, right? It is within their definition to invest in early stage companies that have potential for high growth or that have a potential for large market disruption, right? So, your idea is going to need a competent team, and that is where a venture firm comes. They give you the money and they help you build a competent team, right? Yeah. So yes, that is, I'm trying to see if there's anything I missed out. It feels like I left out something. I'm not too sure exactly what it is that I left out. But yeah, I think that's everything. If there's anything that I left out, I'll put it in the definitions episode because there are a lot of words that I feel we need to kind of help define. Right? But yeah, man, this is episode number 23, venture capitalism and venture firms. These are wonderful opportunities for us to find funding if we're entrepreneurs. We need to build, if we're investors, we also, as investors, as individual investors, we need to learn how to come together and actually build a venture capitalist industry. If you're in Polokwane, if you're in Limpopo, holla at me because I definitely am trying to build a venture firm because I see there's a large opportunity for startup entrepreneurs. There are a lot of startup entrepreneurs that I know in fashion, in food, in farming, in agriculture, agri-tech, So I think these people need funding and maybe banks could be unwilling. But as venture firms, as venture capitalists, we have an opportunity to gather resources and then funnel them in the right place. Oh, I think that's what I thought I was leaving out. So going back to the initial description, a lot of venture firms, when they raise their funds, like their funds, right? So I have a fund, a 200 million rand fund. A lot of the people that invest in the fund expect their money back in 10 years. So that 10-year program allows for the venture firm, again, to kind of lose here and win there. And like I said, a lot of them will make their exit at the IPO, but sometimes if the firm is leading Series A and is leading Series B, they might exit in Series C, right? They might say, okay, well, our fund is about to expire. We need to pay back the people that invested us and then sell all the shares that they have to anybody else that's willing to buy. But that's why, the term sheets have lock-in periods, have incentives, have product targets, because everybody that invests in the company, right, should invest in it in good faith. Right, so even if you need to get your money out in 3 years, we need to know that you're looking to get your money out in 3 years. And even in those 3 years, when you're looking to get your money out, you must find as a buyer. It is your responsibility, your fiduciary responsibility to find as a buyer, right? So these are all the things that are described in the term sheets, so that everybody can at least come in an equal footing and leave in an equal footing, and nobody feels like they were cheated, nobody feels like they were conned or disrespected or lied to, right? So yeah, a lot of organizations that invest in these foundations, these NPOs, these trust funds, their minimum lock-in is about 10 years. But venture funds, because I can do a fund in 2012, why am I going so far back to 2012? I can do a fund this year in 2021 and then raise 200 million. And then by 2023, I've kind of used up all the funds. And then I can do another fund in 2024 for another 200 million, even though the funds will overlap as to when they're going to expire, right? But venture firm that actually works, that works efficiently and effectively, can have multiple funds running at the same time, investing in multiple businesses at the same time with overlapping exit strategies, right? So yeah, that is just another thing you need to understand about these venture firms. So I hope I explained everything about the basics in understanding the venture capitalist ecosystem. because again, these are really, really, really large sources of capital, right? And we need to learn how to engage these venture firms. We need to learn how to fulfill their minimum requirements, and we also, need to understand how to speak the business language with these venture firms, right? So it's Financial Independence, Retire Early. Thank you for watching. Share this content with anybody else who you feel might find this content interesting. I'm gonna leave my description. I'm gonna leave my my contact details in the description as always. Hit me up. Let me know what you'd like me to talk about next. Yeah, bye.